learning platform. We continue with our block revision, December 2024, and today we are tackling question 1B. So this is how the question reads. Kamali and Kalangi have been trading as Kaka Enterprise. The entity had reported a net profit of 484,900. However, the reported profit was disputed by the Revenue Authority during the year of income 2023. The assessed taxable income for the partnership by Revenue Authority was 3,880,000. The partners have provided the following details to assist them prepare for the adjusted taxable profit, which would assist in determining whether the assessment by the Revenue Authority was fair. So we have a bank account that is receipt and payment. So on the receipt side, we have balance as at January 2023. That is a figure of 1,840,000. We have the receipt from debtors, a figure of 3,600,000. We have the cash sales, a figure of 720,000. We have a sale of motor vehicle. The figure is 360. Then you have 15% bank loan, that is 400,000. Then balance carried forward. We have a balance carried forward of 960. On the payment side, we have what we call the cash purchases. The figure is 500,000. We have payment to creditors. That's a figure of 1,890,000. We have electricity, a figure of 188,000. We have telephone expense, a figure of 172,000. And we have what we call purchase of furniture. The figure is 350,000. We have general expenses. The figure is 3.7 million. We have salaries and wages. The figure is 480. We have office computer. The figure is 180,000. Then we have rent expense. The figure is 240. Then we have insurance 96. Then finally the last payment is advertisement. The figure is 84. So being told that partners contributed capital of 400,000 and 600,000 for Kamali and Kalangi, respectively, which was included in the opening balance. So the figure of 400 and 600 was basically included in the opening balance. And you're being told on additional information number 2 that general expenses include the following item. General expenses included the following items which were debited in the statement of profit and loss account. We have the first one, that is a breakdown for a general expense. We have computer software. The figure is 90,000. We have donation to a political party. The figure is 300,000. We have defending Kalangi in a land dispute. The figure is 350,000. We have withholding tax. The figure is 32,000. We have installation of neon sign. The figure is 48,000. Then we have 15% bank loan, inclusive 15% of the bank loan, inclusive of interest. The figure is 200,000. We have lease rental payment. We have 82,000. Purchase of motor vehicle. We have a figure of 1.2. Then we have purchase of a piece of land for business. That is 742,000. Then we have what we call purchase of motorbike for office use. The figure is 200,000. We have auditing fee. The figure is 96. Then we have what we call the partners drawing. The figure is 360,000. On additional information number 3, we're told that other details. So we have creditors at the beginning, that is balance brought down, and at the end. So creditors at the beginning was 550, creditors of good. At the end was 1,460,000. We have debtors of goods, the figure was 640. And at the end, that is December 31st, that was 820. Then we have salaries and wages accrued. Salaries and wages accrued, that was 120,000. And then at the end, we have 89. We have rent expenses prepaid at the beginning, that is balance brought down January, 36,000. At the end is 24,000. Then we have what we call office computers. So at the beginning, there's an office computer of 150. At the end is 240. So we have inventories of goods. Inventory at the beginning was 192. Inventory at the end, that was 120. Then we have what we call cash at bank. At the beginning, cash at bank was 840. And at the end, that was 960. So then we're being told the salaries and wages included. Salaries paid to domestic worker for partners amounting to 96,000. Then you're being told that the total sales and purchases for the year 2023 were undercasted by 20%. Then you're being told that the 15%, we are told the 15% bank loan of 400,000 relate 15% bank loan of 400,000 relate to repairs to private residents of Kalangi. Then you have telephone expenses amounted to 60,000 related to partners' personal calls. Then you're being told that rent expenses were understated by 25%. So required, we're being told that prepare a revised statement of adjusted profit or loss for partnership business. The number 2, advise partners in relation to the assessed profit by Revenue Authority as compared to the adjusted taxable profit obtained in B Roman 1 above. So we begin to the analysis. We're being told that the two partners, basically Kalangi and Kamali, and they have been trading as what we call Kaka Enterprise. And these individuals, this partnership basically reported a profit of 484,900. However, this profit was basically disputed, meaning that the Kenya Revenue Authority did not agree with their calculation of profit, and they say that upon the assessment, that says that the profit should have been 3,880,000. As a business, one of the things that will prompt you, if you look at the variance in those profit, there's a variance of 3.2 of about 3.5 or 3.4 there, and that variance will prompt as a partnership to look for an expert to actually assess what Kenya Revenue vis-a-vis what they calculated to confirm whether that is true. So upon that, we're being told that partners have provided the following details. So we have receipt and payment, where we have balance brought down, which is 1,840,000. On that breakdown, we know that there's a partner's capital contributed, which we have 400,000 for Kamali and 600 for Kalangi. So on that 1,840,000, a million is basically capital contributed by the partner. But on the last information, on additional information and 3, balance brought down, we can get that if we less that capital, a million, we have 840, which is equivalent to cash at bank at the beginning of 840. So that 840 was added to capital contributed. That is what makes it 1,840,000. So we have receipt from debtors. Receipt from debtors, this basically helps us to determine the credit sales. When you talk about debtors account, that will help us to get what we call sales account. It will help us to get what we call sales for the year. We open what we call a debtor stock a receivable account that should help us to determine the credit sales. Then we add it to the cash sales. So we have the cash sales. We know that the cash sales, those are basically what we call taxable income. Then we have sale of motor vehicle. When you talk about sale of motor vehicle, that is a non-taxable income. Then 15% of bank loan, which is 400,000, 15% of a bank loan. which is 400,000. That is not a taxable income. Then balance carried forward, 960. So we go to cash purchases. Cash purchases, those should be allowable expense. Payment to creditors, that item should basically assist us to get the credit purchases. And that means that we're basically going to open what we call a creditor stroke, a payable account. Electricity is an allowable expense. Telephone is an allowable expense if it was deducted. Purchase of furniture. Purchase of furniture is a non-allowable expense. General expenses is allowable unless there's additional information. We will know whether they were allowable, those items. Then you have salaries and wages. Salaries and wages should be allowable unless salary that is paid to partners or paid for partners for private expense. Then you have what you call office computers. Office computer is a capital expenditure. That is a non-allowable expense. Rent expense should be allowable expense. Insurance should be allowable expense. And advertising should also be allowable expense. Unless there is what we call advertising that is revenue in nature. For example, installation of a neon sign. So the first additional information, just a breakdown that we did have, that partners contributed capital of 400,000 and 600,000 for Kamali and Kalangi, respectively. We know that on that balance brought down, there's capital of 1 million, meaning balance for bank is 840. So then we're being told that general expense, the breakdown for the general expense, which were debited in the income statement. So one of it is computer software. If that was debited, meaning expensed, computer software should be non-allowable expense. So that computer, we need to add it back. Donation to political party, that is also non-allowable. If it was subtracted like it was subtracted, we need to add it back. The only donation is donation to a charitable organization. Then you also have defending Kalangi in a land dispute. That is a private expense. That should also be added back. All forms of taxes with the withholding tax should be added back. Installation of a neon sign should also be added back because that's capital in nature and we claim investment. 15% bank loan repayment inclusive of interest. 15% of bank inclusive of interest. Then we have lease rental, that should be allowable. Purchase of motor vehicle is non-allowable, that should have been added back. Then purchase of a piece of land for business, that's a capital expenditure, that should have been added back. Purchase of a motorbike, that's also non-allowable. Expense that should have also been added back. Auditing fee is allowable expense. Partners drawing is what you call non-allowable. So we can open and get what you call debtors control account. Our first working to get the credits, working one, we have debtors control account to get the credit sales. So we have, so debtors is an asset. So we have the balance brought down. The reason why we debit, because that's an asset. So asset we debit, increase in asset. So balance brought down on additional information, that should be 640. And then we have what we call receipt from debtors. So receipt we credit because that reduces receipt from what we call debtors. Receipt from the debtors. We have a figure of 3.6. So what will reduce the debtors? We have the bad debts written off. We have the discount allowed, reducing that. But we do not have those items. What do we have? We have balance carried down, that is debtors at the end. So for the balance carried down, that is the debtors that is carried down, that is 820. So 820, we have that. So what do we have here? We have a figure, 8, we have 4. So we have 4 million for 80,000. So we have 4 million for 80,000. 4 million for 80. So what are we looking for? We have what we call the credit sales, and that is the balancing figure. Credit sales should be the balancing figure. So we get the credit sales. We open that and we have 4480. This is not 80 but 20. That is not 80 but 20 because there's no 60 up there. So 4420, we have 44. We have 44. We have 44. 44. We have 44, 20. 44, 20. Minus 640. So credit sales should be 3,780,000. So we get the total sales. We have total sales should be equals to credit sales plus what we call the cash sales. So credit sales plus what we call the cash sales. So the credit sales is 3780, 3,780,000, and the cash based on the question, we have the cash sales that should be 720. So you had the 720. So total sales for this particular question, when you add that to 720, we have the answer plus 720. So we have a figure of 4.5. A figure of 4.5. We have that as a figure of 4.5. So on that 4.5, because we are resting everything, we pick on additional information number 5. Total sales and purchases were undercasted. Total sales and purchases were undercasted. Were undercasted by 20%. So the figure 4.5, if it was undercasted, we say undercasted by 20%. So if it's undercasted by 20%, it basically implies that 4.5 is 80%. What is the exact sale? That should be 100%. So 100% should be 100 over 80 times 4.5 times 4.5, because that figure is undercasted. So we get the exact sales. So that is 100 divided by 80. So times 4.5. So that should be 56. 5,625,000. That should have been the exact sales. So we get undercast. What is the undercast? Undercast should be 5,625,000 minus 4.5, minus the figure of 4.5. So we have, when you less that, minus 4.5. So we have 1,125,000. 1,125,000. A figure of 1,125,000. So that is an undercast. Sales undercast of 1,125,000. Sales undercast of 1,125,000. So when the sales is undercasted, what is the implication? That it basically meant that the profits were understated. So sales undercast, the correction would be to add back. Sales undercast, that should be to add back. This figure is going to be added back to the reported profit. Is basically going to be added back to the reported profit. We have our working two. Working two is to get total purchases. We all understand that total purchases should be what you call the credit purchases plus what you call the cash purchases. Cash purchases plus the cash purchases. So we open what you call a creditor. Creditor is what you call a payable account. We open what you call a creditor stock what you call a payable account. So when you open a creditor stock payable account, we all know that the balance brought down for a creditor is a credit balance. So why is it a credit? Because that's a liability. One would ask, why do you credit? Because that's a liability. So increase in liability, we credit. That should be 550. That should be 550,000. And then we have what you call payment to creditors. So payment to creditors, that will reduce that. Payment to creditors. 1,890,000. 1,890,000. Do you have discount received? That should be reducing liability. We do not have discount received. We do not have debit not received. So we have the balance carried down. That is balance carried down. So the balance carried down for credit, so that's 1,460,000. So when that is done, as our second working, so when that is done, so 1,890,000 to get the balancing figure plus 1,460,000. 1,460,000. 3,350,000. So we have here what we call credit purchases. So that is credit purchases. So minus 550. So that should be 2.8. So credit purchases, that should give us a figure of 2.8. So we get the total purchases. So that should be 2.8 plus the cash purchases. So cash purchases plus 500,000. So total purchases, that should be 3.3. And the examiner was basically telling us that this figure was undercasted. So sales, additional information, purchases were undercasted by 20%. So the figure that we have of 3,300,000 is 80% because that is undercasted. What about a whole figure of 100%? So that should be 100 over 80 times 3.3 times 3.3. So we get the exact figure for the purchase. So that should be 100 divided by 80, then times 3.3. So that should be 4,125. 4,125,000. So we have 4,125,000. Then we less, to get the undercast, we less 3.3. So that we get undercast. So undercast of purchase. So the undercast for purchase. So minus 3.3. So that should be 825. 825. So basically, when a purchase is undercasted, what happens to the profit? When a purchase is undercasted, the profit is overstated. So what happens to? We are going to deduct. This one we are essentially going to deduct stock less. Because when we undercast a purchase, we increase the sales. So how do we correct? Is by correcting an undercast. So we can move to the next. We can do the salaries and wages. Working three is on salaries and what you call and wages. That is accrual. How do we adjust accrual? So we say expenses paid. We can as well expenses paid plus accrued carried down minus what you call accrued brought down minus accrued that is brought down. So we can still open a T format to have that, but you can as well just have the formula and have that. So for the salaries and wages, we go to the receipt and payment. Salaries and wages, that is paid, we debit. So we debit, but accrual, so this is balance brought down. Accrual we credit because the liability 120. Then we have expense paid, that is salary paid, expense paid. So for the salaries and wages, the figure that was paid, that was 480. Then we have the balance carried down. What we call balance carried down. balance carried down, that should be 89. That should be a figure of 89. So when you add that as a figure for 80 plus 89, so that should be 569. So we have 569. 569. Then you have income statement. This is for salaries for the year. Salaries for the year. So when you less that, minus 120. So we're getting a figure of 449,000. The figure is 449,000. That is accrued salary. So that is the salary for the year. That should have been the salary for the year. That should have been salaries for the year. On that working, that should essentially be the salaries for the year. So we can proceed to the next working. To the next working, we can have the rent, what do you call rent? This is prepayment, prepaid. So how do we adjust? That is expenses paid, prepayment, expenses paid, plus balance, prepaid brought down, minus what you call prepaid carried down at the end. So brought down is at the beginning. We can as well open, this is for the rent. We can open a T format. So in the T format, we have prepaid. So balance brought down. This is prepaid. We debit because that's an asset. So that is an asset we debit. That should be 36. Then expenses paid, that is for the rent. Expenses paid we debit. In expenses paid, that should be a figure of 240. Then we have the balance carried down, that is prepaid carried down. That was 24. That was a figure of 24. When you adjust these figures, we adjust this figure. This is 276. The figure is 276. So what am I looking for? Income statement. So the income statement, this is rent for the year. How do I get the rent for the year? I less 24. So 276 minus 24. So we have 252. So that is the rent for the year. So on this rent, there's an information that the examiner is basically telling us. Rent was understated by 25. So the rent we have, this rent, 252, rent for the year, was understated by 25%, meaning this rent is 75%. What is the exact figure? If the rent was understated, that should be 100 over 75 times 252. So times, we have 100 divided by 75, then times 252. So that should be 336. So we have the rent understated. 336 minus 252 to get the understated rent. So minus 252. Minus 250, that is 84. So 84 was not provided, was understated. If we understate an expense, what happens to the income statement? If we did understate an expense, what happens when you understate an expense? It basically means that we will basically overstate the profit. Overstate the profit. We will basically overstate the profit. And so what do we do to the understatement? We deduct. Deduct. This should have been deducted, but was not deducted, stroke less. So as we adjust that profit that was gotten, we are going to less that understatement. We are going to less the understatement. We are basically going to less the understatement. We can proceed to the next working before we build on the question. Working. So we can pick on the next working. Salaries and wages we were able to get. Office, we can build on office. We have office computers. So we have, that was about, we call it just working or working. So we have what we call office computers. So we have the office computers. We call it just working. So at the beginning, because it's an asset, balance brought down is a debit. So for the office computers, we have 150. Then the examiner telling us that at the end, there's a balance carried down, a balance carried down, a balance carried down of 240. At the beginning, we have 150. That is for the office. That is for the office computers. We have office computers. And we have we have what you call 240. So then again on that list, we have office computer that was purchased. So we have bank, what was purchased, 180. We have a bank of 180. So if you look at this, both ends, we have a figure of 330, a figure of 330. We have a figure of 330. So what happens, at the beginning we had this, we bought 180, meaning the total asset was 330. And then we have balance carried down. The balance carried down is 240. Two things come at the back of our mind. Either an asset was disposed, or there's what you call the loss of value. In that case, because this was an accountant, it provided for what you call depreciation. It provided, we know that P and L, profit and loss, that should be 90. So in this case, it provided for what you call depreciation. Remember, for taxation, essentially we are going to use 330 to claim for what you call investment allowance. We are going to use 330 to provide for what you call investment allowance. So for the investment allowance, we will basically provide in the question. So we can begin the particular question that we have. We can begin, and we can have it as a whole. Instead of this, we just commence it on a plane. So what are we doing? That is very important to understand what we are doing. As a consultant, you have been hired to confirm whether what the Revenue Authority said, that is a taxable income 3 million, is true or not true. What the Revenue Authority said as 3 million is true or not true. So we are adjusting because we have reported net profit. So we say we have Kaka Enterprise. We call it Kaka. We call it the Kaka Enterprises, Kaka Enterprises. That was profit for 2023. Taxable, we call it the adjusted. They need adjusted profit for adjusted profit or loss for 2023. So we have it here. So say reported. We have the reported. What was reported? Net profit. We reported net profit. So the figure for the reported net profit, that is provided in the first information. So being told that the entity reported a net profit of 484,900. So they reported net profit 484,900. So we look at that, we are going to supposed to add back what you call non-allowable expenses in P and L, and what you call taxable income not in P and L. And as I reinstate that for examination purpose, you basically need to understand, but for learning purpose, this is provided. What are you adding back? Non-allowable expenses in the P&L and taxable income not in the P&L. For examination, you basically say add back. You basically just said add back. So we have, if you look at that, we have what you call computer. We start with what you call computer. We start with what you call computer software on additional information of computer software. So the computer software, why are we adding back? Because that's a non-allowable, that's 90. We add it back. We have donation to political party, political party. Donation to political party. That is 300,000. Defending Kalangi, what they call Kalangi in what call private dispute. That's also non-allowable in private dispute. That should be added back. That's 350. That's 350. That's 350. That is 350. That is 350. 350. Then we have withholding tax. Withholding tax. All forms of taxes. We add that back, 32. Installation of what you call neon sign. Installation of what you call neon sign. Installation of the neon sign, that is 48. Installation of the neon sign. A neon sign is a capital expenditure, so we add all of it. Then 15% loan repayment inclusive. So loan repayment is non-allowable. Loan repayment is non-allowable. However, interest on loan is allowable, but we are being told the 15% loan relates to repairs of private residence. So even the interest should be added back. So 15%, we just call it 15% loan repayment because it was repayment. 15% loan repayment, inclusive of interest. Inclusive of the interest. So we add it back because this was less. And a question will be, a learner would ask, why do we add back inclusive? The examiner says inclusive and we add the whole amount. We're adding the whole amount because essentially the interest, that loan was basically to repair private. So that's why we add the whole of 200. The whole of 200 needs to be added back. The whole of 200 needs to be added back. Lease rentals should be allowable. So we have what we call purchase of motor vehicle. So the purchase of motor vehicle, that is 1.2. Purchase of motor vehicle, that is 1.2. So we have what we call purchase of motorbike. That's also capital expenditure purchase of what we call motorbike. Purchase of what we call motorbike. Motorbike is also a capital expenditure. That's 200. But there's an entry that has been skipped on that. That is purchase of land for business use. What we call purchase of land for business use. Land is a capital expenditure. That is 742. The figure is 742. We proceed to this other end. The only entry that has not been done and which we're doing in a question, that is the entries for investment allowance. Those entries, basically we are doing them in a question. Those entries we are doing in a question on that additional information number 3. So we stopped at purchase of a piece of land. Auditing fee that should be allowable. Auditing fee that should be allowable. Auditing fee should be allowable. We have the auditing fee that should be allowable. Then you have partners drawing. So drawing by partners is also non-allowable. Partners drawing. The figure is 360. So that's also an item that is being added back. We look at some of the working. The working that we first did was a working on cells. On that working on cells, we were able to determine the cells that were undercasted. And the cells that were undercasted, based on our working, was 1,125,000. And we say that if a cell is undercasted, if you undercast the cells, you understate the profit. So we need to add back cells undercast, what they call cells undercasted. Cells undercasted, we call it the cells undercasted. The cells undercasted was 1,125,000. 1,125,000. 1,125,000. And we 1,125,000, and that was provided in the working. The figure was basically provided in the working. So telephone expenses amounting to 60 relate to partner's personal call. Partner's personal call. So when you have telephone expenses relating to partner's personal call, when you have sales expenses relating to partner's personal call, that is private expense. So we add it back. Telephone, partner's personal call. We have what we call partner's personal call. We call it the partner's personal call. That's 60, we add it back. We add that figure back. Partner's personal call. So that figure, we had it back. Partner's personal call. So those items we have done. We have done those items. That item is basically added. So then we proceed to less. What items are we lessing? We basically proceed to less. We less. We say less. We have a figure less. What are we lessing? We are lessing what we call non-taxable income. Non-taxable income in P&L, comma, investment incomes in P&L, and what we call allowable expenses not in P&L, not in the P&L. Allowable expenses not in the P&L. So investment income, that is essentially in the P&L. In the P&L. One of the things that learners would probably ask, why is the purchase of furniture not less? Because we are not told whether that was included in the P&L. That's why, but specifically for these other items, we are told these were included in the P&L. So less non-taxable income in the P&L, we less investment income in the P&L, and we also less allowable expenses that are not in the P&L. So for allowable expenses that are not in the P&L, these are essentially what you call the investment allowances. These are the investment allowances, but you can do the workings on purchases. We add purchases on our working, what you call purchases understated. What you call the purchase understated. From our working, that was basically, we have wrapped from our working, we know that the purchase that were understated was a figure of of 825. That's one of the first item that we need to 825. Why are we lessing it? Because when you understate, there were some expenses that you did not deduct. So that means that your profit was high, you need to less it. We also have rent understated. We call it rent undercast. That we also less. The figure is 84. We also less that figure, rent undercast. That was also provided from the workings. That was also provided from the working. So we proceed to what we call the investment allowance. We proceed to investment allowance. And you say this working were not done. Investment allowances. We proceed to what we call the investment allowances. We proceed to what we call the investment allowance. So on the investment allowance, we start with furniture. We start with the furniture. So for the furniture, we know that that's 10% times 350. 10% times 350. We have that as 35. So furniture is under 10%. And that is basically provided on the tax table. If you have the tax table, instead, you can also check furniture and fitting 10% on a straight line. So that figure is provided there. Then we have computers. We have the computers. So the figures for the computers, we have 330. So 25% computers and computer attachment times 330. Times 330. So that should be 0.25 times 330. So that should be a figure of 82,500. 82,500. That should be 82,500. Then you have computer software. Computer software. So that should also be 25% times. The software was 90. So the software was 90, 0.25 times 90. So that should be 22. 22,500. So the next we have what we call, we have what we call motor vehicle. So we have motor vehicle. Motor vehicle is also 25%. So 25% times 1.2. So 1.4 to a quarter of that, that should be 300,000. That should be 300,000. Land does not qualify. When you talk about purchase of land does not qualify for any investment allowance. So we have motorbike. Motorbike should also be basically 25%. So motorbike is times 200,000. So times 200,000, that should be motorbike should be 50. Motorbike should essentially be 50. Motorbike should all be 50. And then we can proceed. There's one item that is on neon sign. On the neon sign. So we have the neon sign. We have it here. We have the neon sign. So we have the neon sign. So for the neon sign, we know 10%. But the neon sign was 48. So times 48,000. So what that is 4,800. So we need to less those items. We need to less those particular items. So we need to add the total items that we need to less, the total items that we need to add back. So we get the total items that we need to less. That should be 825, 84, 825,000 plus 84 plus 35 plus 82,500 plus 22,500 plus 300,000 plus 50 plus 4,800. So the items that we need to less, we are having as 14,03,800. So this ones we need to less. We need to less this item. So that is 1 million. We have it to 1 million. Does it make sense? This is about 1.180. That essentially makes sense. 1,403,800. So we proceed now to items that we need to add back. Items that we need to add back. So we start with 90. 90 plus 300, that should be 390. Then we go to 350. Then plus 32. Plus 32. Plus 48. Plus 48. Plus 200. Plus 1.2. Plus 200,000. Plus 742. Plus 742. Then we move to this. Plus 360. Plus 1,125,000. Then plus 60,000. So the figure is basically we have 4707 for 4,707. 4,707. But we need to read that. We need to check if there's any item that we have forgotten. So salaries and wages, there's something on additional information number 4. So that was not captured, salaries and wages. If you look at this, we don't have the salaries and wages. So, but you're being told that salaries and wages, salary included salary paid to domestic worker for partners. So when you say salary paid for domestic worker, that's a private expense. So we can add it down here. Salaries to domestic worker. So that figure we add it there. So that is 96. That is the item that we've not had. So we look at this, we correct items that we need to add. We add plus 96. So on that 96, we have, this should now be 48. This should now be 48. 4,803,000. So what is the adjusted taxable? So down here we have what we call adjusted taxable profit. This should profit. So adjusted taxable profit. So what is adjusted taxable profit? As a tax expert, you've done that. So the profit that we were adjusting was 484,900. 484,900. How much items are you adding back? You're adding back plus 4,803,000. Then what are you lessing? Minus 1,403,800. So what is the adjusted? What is the adjusted taxable income? That should be 3,884,100. So when I look at that, now as a tax person, when I look at that, the Kenya Revenue Authority did an adjustment. And based on that adjustment, they determined that the figure that needs to taxable profit by revenue was 3,880,880. So after doing that, what should you advise the client? Advise the partner in relation to assessed profit by the revenue compared to the adjusted. If you look at what was assessed, in fact, it is more. So you need to pay more, that is 4,100. So if you're to advise them, the assessed taxable profit is fair. They are the assessed. Just need to know that the assessed taxable profit of 3,880,000 is fair. Is fair. Definitely that is fair because you need to pay even more. Is fair compared to the revised taxable. Compared to, we say compared. We know that compared to what called revised. Compared to revised taxable. Compared to what called the revised taxable. Compared to the revised taxable. Compared to what you call the revised taxable income, the revised taxable income of what you call 3,884,100. That is the taxable profit of this is fair, or by Kenya revenue 3,380,000 is fair compared to revised. So what should happen? The partners, we say should distribute, the partners should distribute the taxable, the adjusted taxable incomes among the partners and pay respective interest and penalties, and pay respective interest and pay penalty, and pay their respective interest and penalties. That is how that particular question is tackled. So we can move to the to Roman 1, still on question 1. So we are being told a tax practitioner faces significant ethical and moral challenges in their work, primarily due to dual obligation they have to the client and revenue authority. Balancing this responsibility can be complex as they must navigate conflicting interest while adhering to legal and ethical standard. So required, evaluate 3 ethical and moral challenges faced by tax practitioners in professional tax practice. So as a tax professional practitioner, you're faced with adherence to the client and again adherence to the revenue authority. And as you serve, then you're basically faced with conflicting interests. Do you do the right thing or do you serve the client? What are those ethical that you're faced? Confidentiality. One of the information is confidentiality. Ethical standard is confidentiality. Keeping a client's information confidential, should not disclose about client. Should not disclose confidential, we say information about the client. That is the first ethical issue. Should not disclose confidential information about the client without their consent. Without what you call their consent. That is the first ethical issue they face. Do you disclose or you don't disclose? So one of the ethical issue is what you call confidentiality. You should not disclose information of the client without their consent, So there can be dilemma, especially in that particular, especially where the client is on the wrong side, and you have to sort all that issues with the revenue authority. And there's a dilemma on confidentiality, whereby you should not disclose a client information. And if you disclose them, then you're going against ethical issues. Number 2, we talk about client may expect to deliver. The client may expect the tax practitioner to deliver another ethical issue, to deliver what we call the lowest tax bill. As you go about the cases, may expect you to deliver the lowest tax bill. And again, these are some of the issues, especially where a client expects you to deliver the lowest tax bill in terms of penalties and interest. How do you go about it? That is conflicting, where as a tax practitioner, you can go to an extent whether to be corrupt or what to do, where a client expects you to deliver what you call the lowest tax bill. And again, it must also look at ethical standard. As the client is pushing you to deliver the lowest tax bill, again, there are issues to deal with ethical standards. How do you deliver that? That is where you are expected also just to be, as truthful as possible in your quest. Then we have what we call reporting errors discovered. Reporting. What we call reporting. What we call reporting. What we call errors delivered. Reporting the errors that are basically what we call errors discovered in client's returns prior. Reporting errors discovered in client's returns prior. So before, errors that are basically are discovered in client's returns prior in prior years. Sometimes very weighty in prior years. This is sometimes very weighty when it comes to reporting errors that are basically discovered in clients, what you call the client's returns in prior years altogether. There may be resistance by client. There may be resistance. They may experience what you call experience, what you call resistance by the client. They may experience what you call resistance by the client. Client may not agree as you report that resistance by the client, especially if results into additional, especially if it results into what? Into additional tax. Especially when you're reporting this, and by reporting those, then that will lead to what we call additional tax to the client. Again, that is conflicting, client disagreeing and all that. What we call aggressive tax planning. Aggressive, we also have issues to do with aggressive, what we call aggressive tax planning. What we call aggressive tax planning. Aggressive, what we call the aggressive tax planning. And when we talk about aggressive tax planning, 6 aggressive tax planning strategies, Clients sometimes will be very resistant when you're very aggressive, when you're seeking what you call aggressive tax planning strategies, strategy that push boundaries of law, that basically push boundaries of law. This may end up denying, denying what you call revenue authority its fairness altogether. Aggressive tax policy that may push boundary, again trying to deny the right tax that basically needs to be paid. And that is how we essentially tackle question 1.
Hello candidates, and welcome back to the lesson. The subject is Advanced Public Financial Management. Today our focus is on the global best practices in public debt management. That is our today's lesson, and by the end of the lesson you should be able to explain the global best practices in public debt management. Now, effective public debt management is a crucial aspect for governments worldwide to ensure financial stability, to support economic growth, and also maintain market confidence. And we have international financial institutions like the IMF and the World Bank, including the Organization for Economic Cooperation and Development, which have developed guidelines and identified best practices to assist countries in managing their public debt prudently. So the best practices we are going to discuss are practices that have been developed by international organizations, international financial institutions like the IMF and the World Bank. And these best practices emphasize a strategic and comprehensive approach to debt management, integrated within a sound macroeconomic policy framework. So the question is, what are these global best practices in public debt management? And the first practice is in relation to objectives and strategy. Clear objectives and strategy. Clear objectives and strategy. A fundamental best practice is the establishment of clear and well-defined objectives for public debt management. The primary objective is typically to ensure that the government's financing needs and its payment obligations are met at the lowest possible cost over the medium to long term, consistent with a prudent degree of risk. And this is supported by a comprehensive and publicly disclosed debt management strategy that outlines borrowing plans, risk tolerance, and approaches to market engagement. So the first best practice in public debt management is having objectives and strategy. The second best practice is sound legal and institutional framework. Sound legal and institutional framework. Sound legal and institutional framework. An effective legal and institutional framework is essential for good governance in debt management. And this includes clear legal authority for borrowing and also issuing debt. It may include well-defined roles and responsibilities for the entities involved in debt management, such as the Ministry of Finance and the Central Bank, and a structure that ensures accountability and transparency. There may also be need to have a dedicated debt management office with the adequate resources and skilled personnel, which is also critical. Like in Kenya, we have the Public Debt Management Office, which is a dedicated office that helps in the management of public debt. That is a best practice. Sound legal and institutional framework. The third best practice is coordination with macroeconomic policies. Coordination with macroeconomic policies. Coordination with macroeconomic policies. Now, public debt management should be closely coordinated with other macroeconomic policies, particularly fiscal and monetary policies, such that effective coordination ensures that borrowing decisions are consistent with the overall macroeconomic objectives, such as maintaining price stability and fiscal sustainability. And debt managers should provide fiscal authorities with information on the cost and risk implications of financing requirement. The fourth practice is in relation to risk management. Risk management framework. This means identifying, assessing, and managing the various risks that are associated with public debt portfolio. That is a cornerstone of best practice. And key risks include refinancing risk, we may have market risk, operational risk. There is also contingency liabilities. So those are some of the risks in the risk management framework. Moving on to the fifth global best public debt management is development of a well-functioning domestic debt market. Development of well-functioning domestic debt market. Development of a well-functioning domestic debt market is yet another best practice in public debt management. That is to mean promoting the development of a deep, liquid, and efficient domestic market for government securities, and which is a key best practice. That is to say that a strong domestic market reduces reliance on potentially volatile external financing, and it also provides a stable funding base and offers a channel for transmitting a monetary policy. And that involves issuing a predictable calendar of securities, promoting a diverse investor base, and ensuring efficient trading and settlement system. Transparency and accountability, number 6. Transparency and accountability. Now, transparency in public debt management is crucial for building investor confidence and also enabling public scrutiny. And this involves regular and timely publication of comprehensive data on public debt, including the size and the composition of the debt, the composition of the debt portfolio, borrowing transactions, and debt service payments. So there should be clear reporting on debt management objectives and strategies, and also performance, which is very important. There ought to be also independent audits, and this is audits of public debt activities, which enhances accountability. 7. Prudent borrowing. Prudent borrowing is a best practice in public debt management. Best practices emphasize borrowing on the most favorable terms and conditions available in the market, considering both cost and risk. And that involves careful analysis of market conditions. It involves engaging in competitive bidding processes such as auctions, and also negotiating effectively with lenders, and so on. So borrowing should be aligned with the purposes outlined in the budget and the purposes outlined in the development plans. The 7th or 8th best practice is regular debt sustainability analysis. Regular debt sustainability analysis. Regular debt sustainability analysis. That is to mean conducting regular assessments of debt sustainability, which is vital to ensure that the level and growth of public debt remain on a path that the government can service without compromising future fiscal stability or economic growth. And this analysis helps to identify potential vulnerabilities and also informs corrective policy actions if needed. So these are 8 global best practices in debt management. 1 is clear objectives and strategy. Number 2, sound legal and institutional framework. Number 3, coordination with macroeconomic policies. 4, risk management framework. 5, development of well-functioning domestic debt market. 6, transparency and accountability. 7, prudent borrowing. And lastly, regular debt sustainability analysis. So candidates, the adhering to these best practices helps governments to manage their debt effectively. It helps governments to minimize risks and costs, and also to contribute to the overall macroeconomic stability and also sustainable development. These are 8 global best practices. Thank you for attending the lesson. That will mark the end of this lesson. I'll hope to meet you in our next lesson where we continue to share knowledge in public financial management. Bye-bye.
We continue with our series that is block revision, December 2024. And we are continuing with question 2. So we read the question. We are being told that Bright Star Electronic Enterprise is a small business operating in the retail sector. The business has experienced steady growth in sales over the years. The owner, John Irungu, handled most of the financial and accounting tasks. The Revenue Authority has noticed discrepancies in the tax returns over the last 2 years, where there's significant variation in reported income and expenses. The business has also claimed several large deductions that appear unusual for the size of the business. These red flags prompted the Revenue Authority to issue a notice of tax audit. John Irungu has engaged you as a tax agent to assist him in this matter. Required. So Roman 1, explain to John Irungu objectives of tax audit initiated by the Kenya Revenue Authority. Number 1 is to understand what you mean by tax audit. Tax audits are normally carried to assess whether the tax that are actually being paid are the correct taxes. Audits are carried out to determine whether the discrepancies in the tax return. And we're basically being asked, what is the objectives? Why does Kenya Revenue Authority carry out audit? So number 1 reason is that to increase what we call tax compliance. We say to increase. 1 is to increase. To increase, we say to increase. To increase what we call tax compliance. To have as many taxpayers as possible compliant with the taxes. Compliance by ensuring, what we call the taxpayers. By ensuring the taxpayers, we say that by ensuring that the taxpayers maintain what we call tax record. So why does Kenya Revenue Authority basically carry out a tax audit? They carry a tax audit to make sure that the taxpayers are compliant. How do they get compliant? By basically maintaining what we call tax record. Number 2, we say that deterrence to tax evasion. Deterrent to tax evasion. Tax evasion is a legal means through which people minimize what we call the tax burden. If Kenya Revenue Authority does not carry audit, one of the things that will happen is that taxpayers will not bother even to file returns. They will not bother to file the correct taxes. So to deter tax evasion through ensuring, we say that ensuring proper tax assessment, ensuring proper tax assessment, ensuring what you call the proper tax assessment, through ensuring what you call the proper tax assessment by what you call the revenue, by the Revenue Authority. Proper tax assessment by what you call the Revenue Authority. Next, we say they carry or tax audit to ensure possible areas. If the areas basically the taxpayers keep on evading tax, so to ensure possible areas of improvement, to ensure what you call possible areas, what you call the possible areas, to ensure possible areas, to ensure identify, not just to ensure, to identify possible areas of improvement. Where does the Kenya Revenue needs to improve If it's in terms of collection, what are these collection measures that need to be put in place? Again, they carry audit to recover, to recover tax evaded, to recover the tax that is basically evaded, plus penalties and interest, plus what you call penalty, and what you call and interest, plus penalty and interest to recover what you call the tax evaded, plus the penalty and interest to recover the tax that is basically evaded, to recover the tax that is evaded, plus what you call penalties and interest, plus penalty and interest. Basically, on that, the examiner was basically looking for about 3, but you can add a number. We can say educate taxpayers, educate what you call the taxpayers on areas where they have problems. So that basically says that when an audit is carried, a taxpayer, not tax authority, will basically identify possible areas of problems for the taxpayer, and the taxpayer possible areas, and educate the taxpayers on possible areas where there are problems in complying with the tax laws, in complying, we say, with what we call the tax laws, areas that they need to actually check on. That is question 2A, Roman 1. We proceed to Roman 2, and then we read the question on Roman 2. So Roman 2, the examiner tells us, analyze 3 responsibility of a tax agent to a client during tax audit process. So when the revenue authority is carrying audit, what is the responsibility of a tax agent? Tax agent is a professional that is basically handling tax matters. So in relation to audit process, we know that help assess risk. One of the things help, one of the function is help to assess what you call risks associated. Risk that is associated. We say that risk that is basically associated with the audit finding, with what you call the audit finding, risk that is associated with the audit finding. Some of the risk could basically lead to maybe paying double the tax, or maybe some can lead the taxpayer to going to jail, associated with tax audit finding, tax audit finding, and identify, and you say identify ways of managing them, we say managing them effectively. After identifying, a tax agent who is an expert is not basically going to stop at identifying the risk. Is also supposed to come up with better ways of managing those risks as the first. The second, we can talk about the tax helps in organizing, and say reviewing what we call the client's financial records. So when it happens, for example, that an audit is being carried, you not just basically as a tax agent be there and watch audits being carried. At that point, you also be organizing and reviewing the client's financial record. What is the essence of reviewing client's financial record? To facilitate. This is to facilitate to facilitate what we call the audit, to facilitate the audit process, so that you are in charge. Whenever this is asked, you're able to deliver the records. You review, you deliver. When this a question is asked on incomes, you're able to provide that. But we also say that one of the things that happen, if any error is found during the audit, if any error is found, say during the audit, if any error is basically found during the audit, as assessment is being done, and that is the audit, audit can help to correct. It can help to correct. It can help to correct. It can basically help to correct them in a way, help to correct them in a way that mitigates penalties, in a way that basically mitigates, helps to avoid penalty, mitigates potential penalties, and what you call potential, and what you call the potential tax liabilities. Potential tax liability. It can mitigate them. It can help to correct them in a way that will assist the client not to incur penalties and interest. Serves as an advocate of the taxpayer. Serves as an advocate of the taxpayer. Serves as an advocate, basically representing the interest of the taxpayer, and that's why we say serves as an advocate of the taxpayer during the audit, during what we call the audit, and we say, and representing, stroke communicating what we call the interest of what we call the taxpayer, communicating interest of the taxpayer. That is how we basically handled that question 2, December 2024, question 2. Welcome to Manifested e-learning platform. Today we have our block revision, December 2024, and precisely we're handling question 5D. We read the question. High Tech Contractors Limited has been in construction business for many years. The following information relate to one of its construction contract for the year ended 31st December 2023. So balance as at 1st January 2023. So material on site at the beginning of the year, that was 30,000. We have what we call accrued wages. Accrued wages is 2 million, rounded to 1,000, that should be 2,000. Rent prepaid, and into bracket we say contract related. The figure is 4 million, but rounded to 1,000, so we have 4,000. Then we have what we call plant, and the figure is the written down value. The figure is 20 million, rounded to 1,000, and so we have 20,000. So transactions during the year. Number one is material sent to the site, that is 100,000. Then there's a plant that is purchased. The figure is 10,000, but that should be 10 million because it's rounded to 1,000. We have wages paid, that should be 8,000. Inspection fee, that is 2,000. Then we have consultancy. Fee. The figure is 2,000. We have subcontractors fee. The figure is 1,000, but the figures are rounded to thousands. Then we have what we call consultation fee. The figure is 3,000. So we're being told that materials sold, and we have a cost of 1,500. Then we have what we call casual laborers. The figure is 2,000, but rounded 2,000, that should have been 2 million. Then we have what we call head office expenses. The figure is 3 million, but rounded to 1,000, that should be 3,000. We have deposition expense. The figure is 4 million, rounded to 1,000, that becomes 4,000. Then we're being told that rent paid, and we're being told that that is non-related. The figure is 8 million, so rounded to 1,000, that should be 8,000. Then we have other expenses, and into bracket we are being told that is allowable. The figure is 2 million. We have the figure of 2,000. Then we have what we call the value of work certified in the year. So the value of work that is certified during the year, the figure is 120 million, rounded to 1,000. That should be 120,000. Then we have what we call cost of work uncertified. The figure is 20 million, rounded to 1,000. That gives us a figure of 20,000. Then we have what we call cash received from client. Cash received from client. The figure is 80 million. The figure is 80 million. 80 million rounded to 1,000. That becomes 80,000. Then we have what we call balances carried down at the end of the year. We have material on site. At the end of the year, the figure is 50 million. Rounded to 1,000, that should be 50,000. We have wages accrued at the end of the year. That is a figure of 4 million, rounded to 1,000. That should be 4,000. Then we have what we call rent accrued, and we are told that that is contract related. The figure is 5 million, rounded to 1,000. That should be 5,000. Then the examiner gives us additional information. It tells us that investment allowance agreed with the Commission of Revenue is at the rate of 10% on plant. That the investment allowance agreed with the Commission of Revenue Authority is at the rate of 10% on plant. Then the second additional information, we're being told that the company's policy recognizes 2/3 of annual profit when they arise for tax purpose. Then lastly, any contract loss are recognized in full in the year of the occurrence. Then we read required. Number one, required, we're being told to compute contract profit or loss for the year ended 31st December 2023 for high-tech contractors. Number two, we're being told that determine the taxable profit or loss for the year ended 31st December 2023, assuming that there were no other contracts. So the first required, that is Roman 1, is basically 6 marks. The second required, that is Roman 2, is basically 2 marks. So we can begin the analysis of the question. So the analysis of the question, just to read it, we say high-tech contractor has been in construction business for many years. The following information relate to one of his construction contract for the year ended 31st December 2023. So basically, a question is on construction. So the first one, when you have materials balances at 1st January 2023, those are balances brought down at the beginning, meaning they come from the year 2022, now in the year 2023. So material on site, that is 30,000 at the beginning. We have accrued wages, that was 2 million, that is 2,000. Then we have rent prepaid, contract related, that should be 4 million, rounded to 1,000, that should be 4,000. Then we have plant written down value, the value at the beginning of the year, that should be 20 million, rounded to 1,000, that should be 20,000. Analysis. Material on site, basically when you're doing this, is part of an allowable expense, because one of the items that are one of the allowable expense, it needs to be added to materials that are basically sent or bought in the year 2023. Then we less the materials that are sold and materials at the end of the year. When it comes to accrued wages, those are accrual. How do we adjust accrual? We basically say that accrual we adjust in the following. So when you talk about accruals, we will say accrual, we say expenses paid, we had accrual, we had what you call accrual carried down, then you have what you call accrual, we have the accrual brought down. That is how we less the accrual brought down, not adding, but we less the accrual at the beginning of the year. At the end of the year is carried down, brought down at the beginning of the year. So that is basically on accrual. How do we adjust prepayment? How do we basically adjust prepayments? When you talk about prepayment or prepaid expenses, we will say that expenses that are paid, we have the expenses paid, we had to prepaid, we had what you call prepaid brought down, and then we less what you call prepaid, we less the prepaid carried down, we less the prepaid carried down. When you say prepaid brought down, that is prepaid at the beginning of the year, prepaid carried down, that is prepaid at the end of the year. That is as far as we are talking about prepayment and accrual. Those are what we are going to adjust. For these expenses, when you talk about wages and we talked about rent, those are allowable expenses. Then on the written down value for the plant, that is on the balance breakdown, that is an item that you're going to add if there is any plant that is bought in 2023, we add it to the balance breakdown, and then we claim investment allowance. We are given at additional information 1 that we claim it on plant at the rate of 10%. We proceed to the next material on site. We say that we are supposed to add it to the balance breakdown. We can do the adjustment. Those are materials at the end, and also materials that are sold, so that we get the total material cost, which is allowable expense. Then we have plant purchased. So we can do our first working for the plant, which we're going to claim investment allowance. So we have a balance breakdown plus what you call purchased, plus the purchased. So on that working, we have the balance breakdown for the plant that should be 20. Then we have what you call the purchased. The purchased is a figure of 10,000. So what you're going to claim on investment allowance, that should be 30. But remember, the figures are rounded to 1,000. So that is basically on the plant. Wages paid. We have wages paid. We can do the adjustment on wages. So we can have it as working 2. This is plant. Once the wages are done, once the workings are done, it becomes much easier. So wages that are paid, we have wages paid, that is 8,000. Wages that are paid is 8,000, but we have accrual. So we now have the accrual at the beginning brought down, which we need to less. Then we check the balances at the end. We're told that wages accrued at the end, that should be minus 4,000. Plus 4,000. That should be plus 4,000. So this is paid, accrued, brought down. Then we have the accrued carried down. So on this, we are going to have 8,000 minus 2,000, that is 6,000. So for the wages for the year, we have a figure of 10,000. That should be 10 million for that. That should be 10 million. So then we go to what to call inspection fee. Inspection fee is allowable expense. Then you have subcontraction fee. That is a work that is specialized given to another person. Subcontraction fee, that is a figure of 1 million. That is also allowable expense. We have what you call consultancy fee. Consultancy is allowable expense, but you can do the working for material cost. We have the material. So for the material, we have the balance breakdown, which you have as a figure of 30. We have the material that are sent to the site. That should be 100,000. That should be working 3. So then we know that we less materials that are sold, that is 1,500, and then we less material at the end. If you look at balances at 31st December 2023, that is minus 50. So we less the 50. So material cost. So we said that materials that are brought down, this is balance brought down, materials that are brought to site, materials to site, we have materials sold, we less that, then we have carried down. So to get the material cost for that year, so we are going to have 30,000 plus 100,000 plus 100,000. So that is 130, then we less 1,500, then we less a figure of 50,000. So the material that are basically allowable expense, that should be 78,500. That should give us 78,500. That should give us a figure of 78,500. So then we proceed to the next, what we call casual labor. Casual labor should be allowable expense. Then we have what we call head office expense. When you talk about related companies, we tax head office and the branch together. So that should be allowable expense. Then we have what we call the next depreciation expense, and into bracket provision. In taxation, depreciation expense is what we call non-allowable expense. We call it a non-allowable expense. Then the next one, we are told that rent paid, and into bracket, very examiner is very clear, non-contract related. So when you talk about rent that is paid but is non-contract related, then that is what we call non-allowable expense. Then the examiner moves and says that other expenses, and you're told that those other expenses into bracket allowable, meaning those expenses will be treated as allowable expense. We are going to less them. So then we have what we call value of work certified. That is basically the taxable income. The value of work certified, that should be the taxable income, not cash that is received, but the value of work certified, whether it has been paid or part of it has been paid, that we have there, but we have the value of work certified as the taxable income. Then you're being told that next is the cost of work uncertified. Uncertified, not approved. Then we have finally the cash received from the client. The figure is 80,000. So I've said that the value of work certified will be the taxable income in this particular question. Then we have rent accrued. We have balances at the end. Material on site, 50,000. Wages we have adjusted. Then rent accrued at the end, which is contract related. So we can have working on the rent. So we call it working for. Working for. We have it as working for. And that working for is rent. And the rent we say contract related. Contract related. Because if it's not related to contract, then it becomes non-allowable expense. So for the rent, we said prepaid rent. We have a prepaid rent, that is prepayment, prepaid rent. Then we have prepaid that we're going to add. We have, do we have rent that is paid, rent that is contract related. So the first one is material, the second is planned purchased, the third is wages. We have inspection, we have consultancy, head office expenses. But for the rent that we have is non-contract related. So we're just going to add, because we don't have rent that is paid. So we have prepaid, brought down, plus the figure of accrued, carried, accrued, plus accrued, carried down. These ones we are going to add. So for the rent prepaid, that is brought down, that should be 4,000. Then we add the accrual at the end, that is 9,000. So for the rent that is allowable expense, that should be 9 million, but we round to thousands, that should give us 9,000. So with that analysis, we only need to read additional information once again, just to stress on what we really need. So being told that investment allowance was agreed with the Commissioner of Revenue at the rate of 10%. So where are we going to claim it? We are basically going to claim it on the working one, on the investment allowance. This is where we are going to claim investment allowance at the rate of 10%. But you're being told on the second additional information, we have what we call the company recognize 2/3 of annual profits when they rise for tax purpose. So that is basically going to help us to determine the tax of profit for the year, because they only recognize two-third when they rise for tax purpose. So any contract loss are recognized in full in the year of the occurrence. So determine, number one, compute contract profit for the year ended 31st December 2023 for high-tech contractors. So as a norm, we have it as a whole on this other side. So we will have the question, that is Roman 1. We have what we call high-tech contractors, high-tech contractors. Contract, this is the contract. We have it as profit or loss, contract profit or loss for 2023. So we have that for the year 2023. So then we have the taxable operating income. It's not the cash received, but that is basically, we have it as the value of work certified in the year. Value of work certified in a year. So the value of work certified in a year, so the figure is 120. The figure is basically 120. Then you say less allowable expenses. Less allowable expenses. The first allowable expenses that we did, it's working. We talk about material, and we've done the working for the material. We know that the breakdown was 30. Just to put it down, what you have done, 30 plus 100,000. Then we less the materials that were sold. Again, we less the materials at the end that are still pending. So that gives us a figure of 78,500. Then the next is what we call plant investment. We can have investment allowance, and this is plant. So for the investment allowance, which is for the plant, the balance breakdown was 20 plus the one that was purchased, so that is 30. So we have 30 and times 10%. So the investment allowance basically there is 3,000. So we move to the next, that is wages. We have the wages. The workings on the wages were also very done. We've said 8,000, what has been paid, plus accrual carried down. That should be 4,000. Then you have minus 2,000. So that for the material, we have a figure of 10,000. Then you talked about inspection fee that was allowable. We have what you call inspection fee. We have the inspection fees. That is 2,000. We have what you call subcontractor fee. That is 1,000. That's 1,000,000. We have consultancy fee. So for the consultancy fee, we have that as 3,000, which should be 3 million. We have casual labor. So for the casual labor, there's no adjustment. For the casual labor, we have a figure of 2,000. Casual labor is 2,000. So the next that we have, is what we call head office expense. What we call head office expenses. So for the head office expenses, we have the figure is 3,000. Head office expenses, the figure is 3,000. Then we have what we call depreciation, provision, that is a non-allowable expense. Then when we talk about rent, and rent we also told non-contract related, that should be non-allowable. Then we have what we call, we have other expenses, and you're told allowable. So just put here other expenses, other expenses, other expenses, other expenses, and the figure is allowable. The figure is allowable, other expenses, that should be 2,000. And then we had rent expense. So for the rent expense, we had prepaid, that is brought down, and accrual. So prepaid and accrual, there was no contract related, but we simply add prepaid, which we add, and accrual that we had. So for the rent, we have a figure of 9,000. So we get total allowable expenses to get the contract profit, to get the contract, what we call contract profit or loss. So expenses, we can add those expenses. We can add those expenses so that we have that. So 78,500 plus 3,000 plus 10,000 plus 3,000, that is 2,000 and 1,000, plus another 3,000, then plus 2,000 plus 3,000, then plus what we call 11,000. 11,000 should be 2,000 plus 9,000. So contract cost, contract this, that is 113,500. The figure is 113,500. So the figure of the cost is 113,500. So once we get 113,500, we have down here, that is what we call the contract. We have the contract profit. Why do we have a profit? Because income, the taxable income, is more than the expense. So the contract profit in that particular question is going to be 120 minus the cost, which is 13,500. So that should be 6,500. But remember, it was rounded to 1,000. That should be 6.5 million. So 6,500,000. That is how we specifically handle part 1, Roman 1. So we move to Roman 2. So Roman 2, the examiner tells us that determine the taxable profit or loss for the year ended 31st December 2023, assuming that there was no other contract. But the examiner tells us in additional information that the company policies recognize only 2/3 of the annual profit when they arise. 2/3 of the annual profits when they arise. That any contract laws are recognized in full. So we need to get the value of work certified. We need to get the value of work certified. And what is the value of work certified? The value of work certified. Value of work certified. So we get the total cost. We get the cost minus what we call cost of work, total cost, minus cost of work uncertified, plus the cost of work plus cost of work uncertified. So to get the value of work certified, so in that case the cost is 113,500, uncertified. The examiner tells us down there, just on the list of items transactions during the year, the cost of work uncertified is 20. So that is minus 20. So the value of work, the cost of work certified, this is cost of work certified. Cost of work, what do you call cost of work certified. So the cost that is certified, when you less that, the cost of work that is certified when we less that. When we get less that, we are going to have 113,500 minus 20,000. So the cost of work certified, that should be 95. That should be 93, sorry, 93. That should be 93,500. That is the cost of work certified. The total cost of this project, the total cost for the project is 113,500. But if you're looking for cost of work that is certified, we have the total cost, then we less the cost of work uncertified. So the examiner, as I read it again, just to emphasize, will say taxable profit. So we're being told that the company policy recognizes two-thirds of annual profit when there are rise for tax purpose. So taxable profit, that is part 2 on the taxable profit. Taxable profit. How do I get the taxable profit? The taxable profit is cost of work certified. Should be cost of work certified. Cost of work certified should be the cost of work certified. Should be the cost of work certified. Should be the cost of work certified. Certified over the total cost, times the contract profit. Contract profit times the contract profit times the contract profit times what you call the contract profit. So once we have that, we know that the cost of work certified should be 93,500. Total cost, that should be 113,500 times, now we give it as we have the figure that is 6,500. So taxable profit. So that should be 93,500 over 113,500, then times 6,500. So taxable profit, that should be 53. We have 53, 54. We can have it 0.63. But remember, this was rounded to thousands. That is the taxable profit. That is the correct position. So that should be that. Then we are being told the company basically recognize only two-thirds of the profit for tax purpose. So the profit that is recognized, that's 2/3 times, we have 53, 54. Reround it to the thousands to get the real figure. So that should be 630. 1, 2, then 0. So that should be the right figure. So the profit that is recognized should be, we have 2/3 times 53, 54, 630. So the value of the profit recognized, that should be, we have a figure of 569, 753.33. That is the exact figure. The profit that is recognized should be that figure. That is 3 million. The figure is basically 3 million. The figure is 3,569,753.33. That is how we basically tackle that question 5D. We move to 3A. So 3A. So being told on the 3A, the government provide various tax incentives to both individuals and entity with an intention of achieving various tax objectives. Analyze 2 tax incentives provided by government to encourage home ownership in your country. Number 1 is what we call claiming mortgage interest. Claiming. We say claiming mortgage interest, claiming what you call the mortgage interest. So when you talk about mortgage interest, those who take or loans or mortgage in order to own homes, particularly, we say that we compare the allowable deduction, the allowable deduction, deduction is what you call the lower of. We basically interest paid, you compare with the set limit, that is 25,000 per month or 300,000 per annum. So you get the two and get the law of that. That is for mortgage, for those who are intending to take mortgage in order to own home. So interest paid you compare with the set limit, that is 25,000 per month or 300,000 per annum. But you're saying that this is up to December 2024. However, as an emerging issue, we say that mortgage was basically increased to 30 per month and 360 per annum. But that is for an emerging question, if you ask an emerging question, but particularly questions that require calculation, those who pertain to 2024. Then we have what you call affordable. We have number two, affordable housing levy relief. Affordable housing levy relief. This is basically for those who contribute to affordable housing. This is basically for those who contribute to what we call the affordable housing, for those who contribute towards an affordable housing scheme. Those contributing, we say towards what we call affordable housing scheme. So the claimable amount basically would be the 15%. The claimable amount is the lower of. So we say 15%. 15%, we have that as 15%. 15% of housing levy paid. Of housing levy paid. Compared with 9,000 per month or 108,000 per annum. That is as at 2024. But you can also have what you call contribution to HOSP. So HOSP is what you call home ownership saving plan. When you talk about contribution to HOSP, that is home ownership saving plan. So for the home ownership saving plan, we know that amount contributed, lower of. We know that lower of. We have amount contributed, amount contributed, and we know that the set limit, 8,000 or 96,000 per annum. Then we can proceed to part 2. So part 2, we're being told that is B. This was A. We proceed to 3B. So 3B, we're being told that tax information exchange agreements, that is TIES, are bilateral agreement between two countries aimed at improving what we call tax compliance and reducing tax evasion. While tax information exchange agreements are intended to enhance transparency and ensure that taxpayers are meeting their obligation through information sharing, they also present challenges for developing countries. Argue 4 cases against tax information exchange agreements that are encountered by developing countries. Number 1, we have what we call cost implications. We have what we call cost implication. What do you call the cost implication? What is the cost implication? So for the cost implication, Setting up and executing. Setting up, we have talk about setting up and executing. TIES, tax information exchange, tax information exchange agreements. They have a cost implications. It is very expensive to basically that. Then we have as we increase administrative cost. We have what we call as next we have what we call increased administrative cost. Number 2, cases against, we call it increased administrative cost. Increased administrative cost, and that is basically to say that establishing procedures and system, establishing procedures. We have the procedures and systems to manage TEIS, tax information exchange systems. So that is the second arguments against. The third, we talked about deterrence of foreign investment. Deterrence, what we call deterrence of what we call foreign investment. A number of investment that comes basically from foreign countries are actually against what we call tax information exchange agreements, because those that investment do not require this information basically to be passed to another country. So basically with that, it deters what we call foreign investment. And when you talk about foreign investment, these are basically investment from other countries. And lastly, we can talk about different countries have different countries. We have as different countries have what we call have different standards and procedures in relations to tax information and exchange tax information exchange. So when you look at maybe Kenya and Europe, or one of the countries in Europe, we look at UK or we look at Scotland, you find they have different procedure in terms of tax exchange information, leading to what we call inconsistencies in TIES. So TIES, tax information exchange agreements. So because the different countries have different standards and procedures in relation to tax information exchange, it leads to inconsistency, difference, or we call the inconsistencies in tax information exchange agreements between different countries. So that is how we basically handle question 3, that is Roman A and Roman B.
Greetings, candidates, and welcome to the Advanced Public Financial Management lesson. The subject topic in both national and county governments. In our today's lesson, our focus is on the establishment and functions of the Public Debt Management Office in Kenya. Establishment and functions of the Public Debt Management Office. There are two things: establishment and functions. And candidates, in Kenya, the management of public debt is primarily entrusted to the Public Debt Management Office, which is a crucial entity operating under the purview of the National Treasury. And its establishment and functions are anchored in the country's legal framework governing public finances. So we begin with establishment of this office. Establishment of the Public Debt Management Office. Now, the Public Debt Management Office is established under the Public Finance Act. It is established under the Public Finance Management Act of 2012. It is this act that establishes the Public Debt Management Office, and the act provides the legal basis for the management of public finances, including administration of public debt. So the creation of the Public Debt Management Office as a dedicated entity within the National Treasury underscores the importance placed on the professional and systematic management of the government's borrowing activities and outstanding debt obligations. So that is the establishment. That is how the Public Debt Management is established under the Public Finance Management Act, and it is a dedicated entity under the purview of the National Treasury. Let's now analyze the functions of this office. What are the functions of the Public Debt Management Office? Now, the functions of the Public Debt Management Office are comprehensive and cover various aspects of debt cycle, from planning and executions of borrowing to recording to reporting and risk management. And the key functions include developing and implementing debt management strategies, planning and implementing debt management strategies, planning and implementing debt management strategies, planning or developing. I think developing could be the right term here. Developing, first of all, developing, planning is just part of developing. So we can say developing and implementing debt management strategies. Now, the office is responsible for formulating the medium-term debt management strategy in coordination with other relevant departments within the National Treasury and the Central Bank of Kenya. The Public Debt Management Office then oversees the implementation of this strategy. It is involved in developing in line with other government departments, but when it comes to implementation of the strategy, it is this office that oversees the implementation of the strategy, ensuring that borrowing activities align with the set objectives of cost minimization and risk management. The second function of the Public Debt Management Office is advising the government on borrowing. Advising the government on borrowing. This office advises the government on borrowing. It provides expert advice to the Cabinet Secretary for National Treasury on matters related to public debt, including timing and terms of borrowing, the choice of debt instruments, and also potential risks associated with different financing options. Function number 3, executing borrowing transactions. Executing borrowing transactions. The Public Debt Management Office is involved in the operational aspects of raising finance for the government, both from domestic and international markets. And this includes the issuance of government securities like treasury bills and bonds in the domestic market, as often in conjunction with the Central Bank of Kenya, as the government's fiscal agent, and also managing the processes for obtaining external loans. So it helped the government in executing borrowing transactions. Moving on to the fourth function, which is recording and monitoring public debt. Recording and monitoring public debt. Recording and monitoring of public debt. It is this office that maintains accurate and up-to-date records of all government debt, including details of creditors, loan terms, interest rates, and repayment schedules, which is a core function of the Public Debt Management Office. And this recording is essential for effective debt management. It is essential also for analysis and reporting. So the Public Debt Management Office often utilizes specialized debt management systems for this purpose. Function number 5 is analyzing debt sustainability. Analyzing debt sustainability and risks. Analyzing debt sustainability and risks. The office conducts regular analysis to assess the sustainability of public debt and also to identify potential risks such as refinancing risk, interest rate risk, currency risk, and so on. And this analysis informs the development of debt management strategies and also helps in taking proactive measures to mitigate these risks. Function 6 is preparing and publishing debt reports. Preparing and publishing debt reports. This is done to ensure transparency and accountability. So the Public Debt Management Office is responsible for preparing and publishing periodic reports on public debt, including monthly debt bulletins and the annual Public Debt Management Report. And these reports provide stakeholders with information on the level, the composition, and servicing of public debt. Function number 7 is in relation to servicing of loans. Managing debt service payments. Managing debt service payments. Managing debt service payments. The Public Debt Management Office plays a role in the process of ensuring that there is timely payments of principal and interest of public debt as they fall due. That's yet another function of this office. Number 8, the 8th function is promoting the development of domestic debt market. Promoting the development domestic debt market. Promoting the development of the domestic debt market. The office is also works towards fostering a well-functioning domestic market for government securities, which is crucial for diversifying funding sources and also reducing reliance on external borrowing. So the office promotes and fosters a well-functioning domestic market for government securities, which is important for diversifying funding sources and also reducing reliance on external debt. So these are some of the functions of the Public Debt Management Office. The first function is developing and implementing debt management strategies. Number 2, advising the government on borrowing. Number 3, executing borrowing transactions on behalf of the government. Number 4, recording and monitoring public debt. 5, analyzing debt sustainability and risks. 6, preparing and publishing debt reports. 7, managing debt service payments. And 8, promoting the development of domestic debt market. Now, candidates, that's all. And it's important as we conclude to note that the Public Debt Management Office in Kenya serves as the technical arm of the National Treasury, responsible for the prudent and effective management of the nation's debt portfolio, aiming to support the government's fiscal objectives while safeguarding macroeconomic stability. And that's the end of our today's lesson on the establishment and functions of the Public Debt Management Office. Under the establishment, you will recall, we noted that the Public Debt Management Office is established under the Public Finance Management Act of 2012. It's also important to note that in Kenya, the management of public debt is primarily entrusted to the Public Debt Management Office, which is a crucial entity operating under the purview of the National Treasury. So thank you for taking time to attend this lesson. In our next session, we will continue to share knowledge in public financial management. Bye.
Welcome to Manifested e-learning platform. Today we talk about digital service tax. So what is digital service tax? And what is the inception of digital service tax? So we need to say that the Finance Act, the Finance Act 2019, the Finance Act 2019 amended the Income Tax Act, amended what you call the Income Tax Act to include incomes from, amended the income tax to include incomes from to include taxation of income accruing. When you talk about accruing, basically accruing from digital, we say from digital marketplace. So if you say that the inception, that is 2019 Finance Act, basically was amended to include income tax to include taxation of income accruing from a digital marketplace, from what we call a digital marketplace. So the Finance Act of 2020, we say that the Finance Act of 2020 introduced that these incomes that basically accrue from the digital place introduced what we call 1.5%, introduced what we call 1.5% on incomes, basically on incomes from services accrued, we say from the services accrued or derived from the digital marketplace. So introduce a 1.5 on incomes from services accrued or derived from the digital marketplace. That was basically the rate of digital tax. And you say tax applicable on gross tax. The tax was applicable. The tax was applicable. We say applicable on the gross. The tax was basically applicable on the gross, what you call the gross transaction value, gross transaction value. And when you talk about the gross transaction values, that is transaction value without deducting the expenditure, was applicable on the gross transaction value of service, of the services, we say provided, of the services provided, provided and due, and provided and due at the time of payment, at the time of payment. So the point is, when you talk about this digital taxes, the rate on the Finance Act of 2020 was 1.5 on the gross value, what you call 1.5 on the gross value. The responsibility, we say that the responsibility, what is the purpose of that? The responsibility to account, we say account for, was basically to account for, tax, account for tax on owners, was to basically account for tax on owners of digital marketplace, owners of digital marketplace, or agents, we say agents appointed, or the agents, or an agent appointed, by the commissioner, or the agent basically appointed by the commissioner, was to responsibility to account for tax on owners of the digital marketplace or agent that is basically appointed by the commissioner, or the agent that is appointed by the commissioner. But very important, we know that the DST, and you say DST, that is the digital service tax, will be collected and remitted. We say you'll basically be collected and remitted by agents. We say appointed, by agents basically appointed, by the commissioner, of domestic tax, remitted by the agents or appointed by the commissioner. Type of transactions where DST, types of transactions where we say DST, the digital service tax, is applicable. Type of transaction where DST, digital service tax, is applicable. So when you say DST, that is basically digital service applicable. One is downloadable digital content. One, you say downloadable digital, we call it digital content. Downloadable digital content, that is where DST is applicable. We have streaming of digital content, streaming of digital content, streaming of digital content where it's applicable. We also have subscription-based media, subscription-based media, another area where it's applicable. We also have online sales of tickets, online sales of the ticket. Data management, what you call data management using what you call the data management using electronic means, using what you call electronic means, as another area where DST, digital service tax, is applicable. Data management using electronic means. We can also talk about learning, learning, and we can talk about what we call search engines related service. Search engines related service. Search engines related service. So these are the areas where we have DST being applicable, where we have DST being applicable, where we have DST, that is digital service tax, applicable. I want us to talk about digital asset tax. Digital asset tax. We talk about what we call the digital asset tax. So what is what we call digital asset tax? We say anything of value, that is basically anything of value, and that is not tangible, and that is not tangible, and cryptocurrency tokens, that is not tangible, and cryptocurrencies, token codes, number held in digital forms. So we say digital is anything of value, is anything of value. Basically, we say anything is anything of value that is not tangible. That is not tangible. And cryptocurrencies, and what we call cryptocurrencies, and cryptocurrencies. We have token codes. We have the token codes. Token code, numbers held in digital, numbers held in digital, numbers that are held in what we call held in digital form, digital form, numbers that are held in digital form. We talk about numbers that are held in digital form through cytographic means, through cytographic, we call it through cytographic means. Numbers that are held through digital form through cytographic means, or otherwise whatever is called, provided altogether. So digital asset means digital asset, what do you call the digital assets? We say includes. So the digital asset basically includes what you call photos, manuscripts. Examples of digital asset, manuscripts. We have documents. We have the documents, and we can name a few. Security token, and the others that we've mentioned, token called security tokens, and we have what you call crypto assets. We have the crypto assets as a form of digital asset, crypto asset. We can also have tokenized assets, what do you call the tokenized assets, But an emphasis here together, when you talk about digital, is anything of value that is not tangible, and cryptocurrencies, token codes, numbers held in digital form through cytographic means. And you say that examples of the digital Digital asset basically includes photos, manuscripts, documents, security tokens, and we have cyto asset and tokenized assets as the types of digital asset. Digital asset. So we need to understand that the Finance Act as an NB, we need us to understand that the Finance Act, we need to understand that basically the Finance Act has introduced digital asset tax payable, as basically the Finance Act has basically introduced the digital tax payable,